So what we have been doing so far is we are like started credit presentation for the last 2 sessions, and then today is our last session. Today is a kind of a is basically it's a continuation of what we have been doing so far. So we'll take 3-4 minutes, and then we'll recap what we have been doing before starting today's session for the benefit of everybody. I think all of you have been with me for the last 2 sessions. Is anybody joined today? I think Yamika is not with us for the last session. Is it correct, Gayani? You haven't joined for the last 2 sessions, if I remember correct. Rest of the team, I think, was with me. Okay. Whoever who joined today, what you need to do is like all the slides have been uploaded in the Google Drive, so you can refer that and get an idea on what we have done so far. Just hold on. So, okay. Okay. Before moving to today's session, I'll take you through what we have done in part 1 and part 2. Right. Basically, part 1 we discuss about fundamentals of credit and type of borrowers and sectors, and we also discuss about why credit is important, sources of funds and uses of funds, like that. Then second day we discuss about type of credits, which is very important in terms of matching the customer requirements in order to support their day-to-day requirements. Like maybe requirements could be like fixed capital or maybe capex requirement, and again the requirements could be working capital requirement. So we have identified different products in terms of customer requirements. Also, we learned about some securities, like wherever when we are trying to give credit facilities to the customers, so we need to understand what are the customer requirements and what type of the products we have, and then on top of that we try to mitigate or minimize the risk when offering these credit products to the customers. Example, let's say we have an NPL customer, and then if we want to give a overdraft facility, obviously we can't give it on clean basis. Why? NPL customer means the customer creditworthiness is very low. Anytime the facility can be moved to the NPA, like bad or provisioning, all those things are possible. Number 2, OD, working capital requirement, we might have an issue because we don't have a better control once we give OD. So product itself we have some issue, customer itself we have some issue. So then we have to drop the customer requirement. But if the customer can bring a cashback security, then we may have to rethink the proposition. Yeah, we are in a position to provide OD facility to this NPL customer, where security being the cash. So then if you take BCS model, borrower credit type security, BCS model, overall we need to think about how we trying to minimize the bank's risk while increasing the profitability. So that's what we learned during first and second session. At the end of the second session, we wanted to, try to find some model in order to assess these customers, because we say the customer is good or bad, customer creditworthiness is high or low, customer integrity is high or low, customers credit willingness to repay high or low. So we can we can judge customer different way. But more precisely, we need to have some method, right? We need to have some mechanism to assess the client willingness, integrity, repayment capacity, creditworthiness. For that, we were trying to understand a model called 5 Cs, right? So some books we have seen it as 6 Cs, right? Credit, character, capacity, cash flow, capital, condition, collateral. That's the 6 Cs. When it comes to the 5 Cs, cash flow and capacity put together, and they say capacity. Or there may be Campari, there may be another model. Right? There are several models we can introduce through that. So we can identify these client creditworthiness, willingness, integrity. Okay or not okay for the credit. So that's what we were learning during the last week under the character. And we have to learn some more parts as well, right? So we have to start from the character, and actually we have completed that. So we'll briefly going through it, and then we will continue. So any questions on what we have done during last 2 weeks? Any thoughts? Any feedbacks? Anything that you need to clarify further? It's up to you. Please let me know so that we can further discuss any issue.
Sir.
Oh, yeah.
That you have said about the BCS model.
Right.
When we take one of the customers as a borrower, we should match with the credit facility.
Right.
And it should be based on the securities, no? That is the.
Actually, generally, when you say BCS model, we have borrower separately, credit separately, security separately. What we can do is we are trying to interconnect these three in order to maximize the bank's profitability while minimize the bank's risk. Right? So sometimes when you are trying to interconnect BCS, we need to take all three into the accounts. Sometimes it is not. I told you an example where NPL customer asking OD facility against cash, where we try to say BCS model interconnected and all three play in a role. But let's say this scenario, a customer is like John Keys. dialogue. Maybe AAA means a customer is very good in terms of repayment. Customer's creditworthiness could be very high. In that case, customer asking OD facility, probably you shall be in a position to give a OD facility even without a security. Why? The customer is so good for that exposure. So in that scenario, S is silent. Only B and C play a role. You're getting my point, actually. Basically,
Yes.
what we are trying to see is like when we are trying to give a facility to a customer, we always have to think in a relative model, like not the absolute perspective. Now, if you say the customer old, not healthy, above 60, so sort of thing, then we absolute perspective is no loans, no facilities, because it is not good to get that kind of exposure. But again, you think about what type of facility is asking: short term, long term, direct, indirect, working capital or capital. So then the equation could be now a bit different. If you remember last time, say even old person could be considered for a working capital. Why? Because old means not healthy. Obviously, we can't give a term loan or a housing loan because it's risky. But short-term loan means post-strategic discounting facility, factoring facility. We are okay to give a facility. Why? Because we know for sure during that shorter tenor, a facility could be settled through realization of checks, realization of stocks. එතකොට ඒ වගේ scenario එකකදී අපි customer විතරක් අරගෙන facility reject කරන්නේ නැහැ. අපි credit එක මොකක්ද කියලා ඒ දෙක interconnect කරන්න. ඊළඟට if you want to see the security, underlying security, it is further easy to take our credit call. එතකොට දැන් මම මේ පැහැදිලි කරන්න ඕන උනේ rather than taking one at a time, absolutely one player will not give you a proper credit decision. තේරුණාද? එතකොට දැන් අපි හැම වෙලේම බරෝවත් ක්‍රෙඩිට් එකත් security එකත් තුනම එකට අරගෙන තමයි අපේ decision එක ගන්න. Then only we understand what is our risk level. What are the risk mitigants? So what's the the profitability that we are having? If not, we can't take a call on isolation. ඒක තමයි මේ BCS model එක හරහා අපි කරන්න බලාපොරොත්තු වෙන්නේ. Is it clear, Ajini?
Yes, sir.
Okay. Yeah. Any other questions, Chatura, Arshani? Any thoughts? Any question? Kushan, Madhushani? Any questions? Anything which is not clear?
All clear, sir.
Right. What about Jute, Kushan, Sammani? How about you? Is it okay? Anything that you need to clear? Any thoughts that you can put into the forum so that we can get the others also get benefited? Arshani?
So can you explain the credit rating wise how's the customer's credit worthiness is determined?
Very good question, Madhushani. Actually, I haven't discussed it this session here, but a bit of advanced perspective. But since we have asked, I will tell you that also. Now, generally, now every bank, now we have been asked to follow credit rating for each customer. Now we have developed internal systems also to rate the customers. Now, when we are rating the customer, we look into several aspects. Actually, what we are doing today is through 6Cs, 5Cs, so Campari model is another method of assessing the customer. But what we are trying to do in the rating system is we will take the some components, some inputs through these models into a system, say customer. When we're discussing about the character, so we have kind of a checklist we have learned last time. So like that, say age, occupation, number of dependents, experience, like that. So we put some marks in order to assess, in order to rate this customer. Similarly, about a collateral or whatever, so you try to assign some score for a different attributes. Say initially, it could be a customer specific attributes. මම කිව්වා ಜಾති. Facility specific පැත්තක තියෙනවා. Only customer specific අපි හිතනවා. So if the customer is in the industry where the industry is thriving, ඔන්න ලකුණු ටිකක් වැඩිපුර හම්බ වෙනවා. එහෙම නැත්නම් if the customer is in the industry where we see lot of issues taken place, ඔන්න එතකොට ලකුණු ටිකක් අඩු වෙනවා. So the customer in say old, not healthy, ලකුණු ටිකක් අඩු වෙනවා. Young, healthy, ලකුණු ටිකක් වැඩි වෙනවා. So like that, what we are trying to do is we assign a score to a customer for the selected attributes. So as an outcome of this score, so you say 0 to 100, so some customers scoring above 90, some 70 to 90, 50 to 70, below 50, like that. What do you mean by that? That score tell you the credit worthiness of the customer. මොකද දැන් ඒ credit worthiness එකට අදාළ parameters, attributes ටිකක් තමයි ඔයා score කරන්නේ. ඒකට ලකුණු දෙන්නේ. ඒතර score model එකෙන් එළියට එනවා score එකක්, ඒ score එකකට relevant අපිට rating එකක් දාන්න පුළුවන්. could be say A double A plus, A plus, A minus, B minus, like that. So it means a customer is good for this exposure if it is a B and above. B and below, we say it's not good for exposure because it's internal. ඒක අපිට universal කරන්නත් පුළුවන්. But in a bank, we use as internal rating. So based on that, we say it's good for this exposure. Double A plus, triple A plus, very good. So when you say dialogue, triple A plus means 0 default. බිඳුවයි. Default probability එක බිඳුවයි. කියන්නේ loan එකක් ගත්තාම ඒක default කරනවා කියන probability එක near 0. ඒක තමයි අපි මේ කියන්නේ rating එක පාවිච්චි කරලා. Right? Similarly, you can rate the facility also, because here when you rate the customer, we call it obligor rating. When you rate the facility, we call facility rating. For the facility, you say the tenor, interest rate, condition, commission. So there may be several attributes for the facility also. Secured or not. If secured, what the like collateral type, right? The land, cash, treasury bills, like that. So a facility also that you can give a rating. Now you have a customer rating, obligor rating, facility rating. So you multiply to get a universal rating for this borrower. Again, it could be something SME 1 to SME 10, corporate 1 to corporate 10, like that. So you can have a rating system applied to each customer in your loan book. In that rating system, higher the rating, we say it's good for the exposure. Lower the probability of default. And අපි මේ ඔක්කොම කරන්නේ මොකටද? කැම්පාරි හරි 6Cs හරි 5Cs හරි ඔක්කොම අපි කරන්නේ ඇයි? To assess the customer's credit worthiness. එතකොට if we can do it through a system, හරි ලේසි. Scoring system එකකින් කරගන්න තියෙනවා නම් it is objective. ඒක subjective නෑ. ඒක දැන් it is not dependent on the person. Say Jaffna manager analyze a customer this way, Martha manager analyze a customer this way. So there may be a disparity. Why? It's a people involved. But if it is a system, it's correlated, either you do it in Jaffna to Martha to Ampara, it's a uniformity. So easy for customer, easy for us. There's a uniformity in rating the customers. When you try to assess or rate these customers, then we need to have some acceptable tested database. Because a new customer comes, and so we assign some marks. Say age, this much. Occupation, this much. Number of defendants, 3 nang megan. Employment record එක මේ ගාන නම් මෙහෙම. Qualification, degree, PhD මෙහෙම මෙහෙම කියලා අපි ලකුණු දෙනකොට ඒ ලකුණු දෙන එක validate කරලා තියෙනවා. Otherwise now මට හිතුණා PhD එකට 3යි මෙහෙම මෙහෙම කියලා, it has not been validated. So validated databases are available. Echo. You also can do it from your bank. Say last 10-year data. You take all individuals given loans and you get the attributes and see whether these guys were promptly paid or not paid. Validation. Then we know this is the score that we need to assign for this type of attribute. Or you can, validate these numbers with maybe international organization. Credit scoring tools. That's another method. So like that, that's a scoring. So scoring would tell you each customer rating. And if you have the rating, it is easy for you to say he's good for this exposure. His credit worthiness level. It's very briefly, that's what we do in rating. So now Central Bank has, asked us to do it mandatory. So every bank has developed internal rating systems. So every facility customer now is being rated, reviewed every year. So depending on the customer perspective information, industry perspective information, management perspective information, financial related information, and the facility related information. This is the rating for this type of a borrower, including customer, environment, and facility. So based on that, we say is AA plus, AAA plus, B minus, C minus, D accordingly. There's maybe 10-point rating scale in general. So based on that, we can say whether it's good or bad for the exposures. Right. Is it okay, Madhushani? You want further to clarify the same or how? Is it okay?
Yes, sir. Thank you very much.
Any other question? Sammani, Ushan, Jute, Ireshi, Ashani? Any questions? Okay. Then we move to today's session. Actually, we have started last week about credit appraisal. We discussed what is consumer credit, commercial development, and international trade credit. Then consumer credit evaluation or the retail individual credit evaluation. The method that we are planning to discuss is 5 C's: character, capacity, capital, collateral, and condition. So started the discussion with respect to character. It's initially what we are trying to understand willingness to repay through past track records, right? Through personal interview. That's about to assess the customer's character, and then further when you want to further understand the customer, so we try to go through customer's personal stability, age and health of customer, wealth, income and expenditure, context. Those are uh, important information. That's what we need to understand. So I have given under each category what are the areas that we need to look into in order to say stability, home, status, occupation. Then age and health is so much important, right? Maybe if it is old, probably we have some risk in terms of in terms of conducting the business, or maybe is not in a position to repay your loan commitments as expected, and that's about age and health. Then other factual information like wealth, income, expenditure, contacts, so very important. So basically, this is the very difficult attribute that you are trying to assess on customer. However, you need to do it at any cost, because without understanding the customer character, it is very difficult to proceed in order to offer the facility to the client. So this is very important: wealth, income, expenditure, contacts, and the rest. Now we move to the capacity, right? Yeah, collateral capacity. Now capacity, when it comes to 6Cs, I was telling you it could be categorized to capacity and cash flow. But when it comes to the 5Cs, we try to understand it under one point, where cash flow and capacity together. So when you say capacity, what we are trying to understand here, in addition what I have mentioned here, we try to understand the customer's capacity to run the business, right? It means not only financial capacity. We think about management capacity, marketing, technical, legal, and other capacity of this individual to run the business, in addition to repayment capacity, which is cash flow, right? What do you mean by the management capacity? Any thoughts? මොකද management capacity කියලා අපි හිතන්නේ? Any idea? Say now customer coming and asking a loan from you, so you are trying to assess his character, which you have done. Then you want to assess his capacity. Under that capacity, now we need to ensure that he has the management capacity to run the business. Any thoughts? What the management capacity කියලා එතන mean කරන්නේ? කාටද කියන්න පුළුවන්? චතුර? කුෂාන්? What do you think? What do you look into as a management capacity of this individual? Part might have, you checked in the character. By ethering stemming from that, whatever attribute you are checking here. Any thoughts? Harshani? Hireshi? One of the management capacity කියලා කියන්නේ. Capacity to run the business. Any thoughts? Madhushani? Sammani?
Manager's ability to grant the loan by maximizing the profit. I think.
No, Madhushani. Now let's say you are a manager and you are assessing the customer capacity. Right? The capacity is not the manager, capacity of the borrower. Getting your point? Getting my point? Let's say when you say character, we try to establish the customer is good or bad for this exposure. Integrity, creditworthiness, willingness. ඒ ටික ඔක්කොම check කරන එක තමයි අපි කරේ character assessment technique. When come to the capacity of the client, means whether the particular customer has the management capacity to run the business. Means whether he has adequate experience to run it, whether he is capable to manage the crisis situation, what is the relationship between with the subordinates, how well that he has put his mission into the action, how well that he is passing his knowledge to his subordinate or maybe the successor. So that's what we talk about management capacity, right? Then api when you discuss about the character, we discuss age ඔක්කොමත් එක check කරනවා වගේම in the capacity you are trying to look into more detail, right? Then what about marketing capacity? So what's whether the particular business is in a position to capture the market. What's the market share? Adequate marketing people are in the business. What is their skill levels? Right? So means when you say capacity, we try to understand in two ways, qualitative and quantitative. Quantitative you would understand, that's the repayment capacity, whether the customer generate adequate cash flows to service your debt, including capital and interest. ඒක තමයි අපි දකින්නේ DSCR එකෙන් හරි interest cover එකෙන් හරි අපි හදන්නේ. අපි loan එකක් දෙනකොට කියනවානේ DSCR තියෙනවද කියලා, interest cover තියෙනවද කියලා. Even personal loan we talk about DSCR of 60% and all that, right? Right? So means then you are trying to assess the repayment capacity. That is the quantitative aspect. That's a cash flow. P&L, the balance sheet, the cash flows, the monthly cash flows, what are your liabilities, what are your income sources, and what's the surplus, and all that is the cash flow related. The rest is whether you can run this business, your capacity to run the business. You have to have marketing ability, you have to have management capacity, you have to have legal. So for example, legal in the sense, if you are a minor, you can't run business. You can't conduct a business. At least you should be older than whatever the government specified age to run the business. Or if you are a government servant, can you start and run a business? What do you think? You can't, right? There's an ordinance saying that government, while you are in the government service, you can't run a private business. You getting my point? Madhushan, is it clear now?
Yes, sir. Yes.
When you say capacity, it's on the capacity of the credit manager. The credit manager looks the capacity of the borrower to run the business, manage the business, achieve the marketing target, to comply the legal requirements, to comply the environmental requirements. ඒක තමයි අපි capacity කියලා check කරන්නේ. And again, you need to compare with available rules and regulations, laws governed by the, put by the government or the legislature. Right? Eva anuwa kina, and they have the capacity to run the business. Now, example, let's say the customer coming and asking you, I want a cashback sort of facility because I am into casino. I am into gambling. If you are knowing the customer is doing that, even though he's asking cashback facility, you can't do it. Why? It's illegal. It's not according to the law. So you can't do that. Right? So basically, you need to understand the capacity of the borrower, capacity of the business. Then you can say, yes, we are in a position to give you a loan. Here, there are some capacity issues. When you say why weak borrowers, public servant ordinance, Ceylon University ordinance, total reduction should not exceed 60% of gross salary. So these are some of the things that you need to be vigilant. Customer is a government servant, so obviously you can't give loans. Under the Ceylon University ordinance also, there may be requirements that you can't do these type of things because in service. Total reduction should not exceed 60% of the gross salary means if it is 70% or so, it's weak borrower. Financial capacity. Borrowing capacity is adu enna patan ganna. You getting my point? So the capacity can be categorized into two. One is qualitative, other one is quantitative. Quantitative means cash flow, actual ability of the client to repay your debts, including capital and interest. When the weak borrowers, the qualitative part is basically is the ability to run the business, ability to conduct the business, about management competencies, marketing competencies, legal compliances, environmental compliances, technical capacity, and ඒව තමයි අපි බලන්නේ ඒ පුද්ගලයාගේ capacity කියලා. Maybe example, let's say the customer coming and asking a loan from you to set up a hotel. When you are going through his credentials, you see the client, having so much of experience into paddy milling, garment trade, whatever, but not the hotel. Then what is your immediate question? He doesn't have a technical expertise to run a hotel. He doesn't have the management expertise to run the hotel. So obvious no in terms, because the sponsor is not in line with the project requirement. Then, but if he's a financial capacity to hire a very good people in the market to run the hotel, then there is a mitigation. That is because it's a financial capacity is there. That could be useful to minimize the impact on management or technical capacity. You getting my point? That's what you need to check. 6 C's or 5 C's kila evaluation ekak karanakota, then we try to say character, capacity, we are trying to measure. We need to assess the situation. So sometimes we might come and we will tell the client, these are some issues because doesn't have experience into the particular sector, particular trade. Then what you're going to do? Then you are trying to understand, right, what other positives we can use to minimize the particular impact. Is having adequate means in financial perspective could be used to minimize the technical or marketing management, because he can hire a very good people in the market to run it. Okay. Any questions? Is it clear? Okay. Then we move to the capital or contribution. Why we think this is important? Any thoughts? Why we think this is important? Any idea? Why do we think capital, customer contribution, equity of the business ඒකයි අපි important කියලා හිතන්නේ? Any thoughts? Harshani, Erang? Say now client, we know assess his character, capacity. Now we are into assess his capital. Why this is important? Any thoughts? කාටට කියන්න පුළුවන්ද ඇයි capital එක එහෙම නැත්නම් equity එක customer contribution එක towards the business important වෙන්නේ ඇයි? Any
The
thoughts?
customer has borrowed funds. If the customer has a borrowed fund, it's the problem of his or her credit worthiness. That's why the capital is important.
Any other? Because now when customer generally total business right being funded by equity and debt. ඕනම business එකක් අපි fund කරන්නේ through debt or through equity. Now if the equity is high, then as a bankers we have a very low risk, because higher equity means right the customer has not borrowed much from outsiders. So in that sense you are trying to give a loan to customer, so as a debt, because we are in comfortable wicket. What about the other scenario? A customer has a low equity and higher debt. Then there is financial risk. As Madhushani suggested, what happens if there is a higher debt component? For that they have to repay capital plus interest. Where he has to generate funds from the business. The business එක හොඳට වෙන්නේ නැත්නම් income එක අඩුයි නම් cash flow අඩුයි නම් ඔයාලගේ financial commitment ගෙවන්න අමාරු වෙනවා. Then as a banker you have some financial risk against this borrower. So in order to mitigate that, what we are trying to do is we try to understand a client what commitment, contribution, equity, capital towards the business, because he generate money, he invests back in the business, right? So in more technically we look these aspects through a ratio called debt equity. The debt equity ratio අපි කියනවා 60-40 තියෙන්න ඕනේ කියලා. Means it's relevant to capacity also, financial capacity බලන ක්‍රමයක් තමයි. But when come to the capital, you know, higher capital means this debt equity portion goes in favor of bank, right? Lower equity means debt equity ratio goes against the bank, because higher debt means higher financial commitment. So we prefer client introduce as much as equity towards the business, so that we are not in a position to have additional risk in terms of financing. That's one. Number two, in terms of contribution, we need to understand in the customer asking a proper amount. Say the customer, in order to complete a say project, a building, requirement is 10 million. So he might come and say, I want a loan of 5 million, I will put 5 million. But first place you need to see whether the total requirement, total cost of the project is 10 or low or high. Say if it is 12 million, then the customer tell you 5 million and he is putting 5 million, there is a shortage because he can't complete the construction. That's one. Number two, if the customer sees that actual requirement is 8, but asking, telling you 10 million is the total requirement, is asking 5 million, mean there is a cost overrun. He's creating higher cost, right? So it's more than the requirement. So means that he's getting the money and may be using the money for some other purpose, which could be an issue because he can't repay because the business is not generating that income, right? So if the real requirement is 5 million and customer is asking 7 million from the bank and he put 7 million as to the business, means 5 million the business, the rest could go somewhere else. But the business generating income for the 5 million you invested. එතකොට ඒකෙන් එන income එකෙන් 5 million එක service කරන්න පුළුවන්, but you can't service 7 million. Means customer could be in trouble. So you need to understand those aspects also, right? So first thing is capital contribution is very important because it is to safeguard the financial risk of the enterprise, business entity, in terms impacted to the bank. The other one is when you put equity to the business, when you put capital into the business, what it says. Because he has a confidence, right? He has a commitment to run the business, right? He has an obligation to run the business. Because now, let's say customer put everything back into the business, means he wanted to, maintain, grow, protect this business. එහෙම නැත්නම් ඔක්කොම loan වලින් නම් අරන් තියෙන්නේ. මොකද වෙන්නේ? Customer does not have a focus on the business. Customer is not putting maximum to run the business. එතකොට බැංකුවේ සල්ලි වලින් මේක දුවන්නේ. ඕනනම් බැංකුවට මේක තියාගත්තත් කමක් නැහැ කියන ගානට customer එනවා. So you can't do that. So you need to make a balance. You can't ask to customer put everything here. There may be a balance between equity and the debt. That's why we say 60-40. Right? So every time you try to make a kind of a balance in terms of conducting the business. Right? So that's what the capital. Any questions? Right. Then the next is collateral. Now we learn character, capacity, capital. Collateral is again very important tool in lending. Earlier also we learned under BCS model. security. It's another word for the collateral, because this is very important. Why we say important? Because when you give a facility to customer, a customer is supposed to pay back without any default, because he is supposed to pay together with interest and capital. If he's not going to do that, you are losing first place your cash flow, creating a financial risk to you. In order to manage this, obtained collateral is very important. In other terms, it's insurance, right? It's insurance. Also, we see this as a safety tool in case of an emergency, in case of an unfortunate situation, in case of an inability to repay due to unforeseen, unavoidable circumstances, right? So the last slide, should never decide to lend if he thinks that he will probably need to realize the collateral. What it means? If you think that the client will not pay, I am going to realize the collateral to repay the debt, is not the proper lending decision, right? At the assessment stage, if you feel that a client is not going to pay, I have security in case of an emergency, or I have a security to go for auction to realize this, then it's not the right method. It's not the right decision, right? So generally collateral, if you remember earlier, when we give a loan, there are three methods of recovery. First one, cash flow. Second way out is collateral. Third way out is guarantees. Means you always try to focus on cash flows to recover your debt. And if you think that the loan is not going to repay and you have collateral to realize, collateral to be used to settle your debts, that's not a good lending decision also. But this is insurance. This is being used to unfortunate situation. So you need to keep that in mind when we discuss, when we take collaterals in lending. Right. Very important part. When the banker decides to obtain collateral, the banker needs to establish a couple of things: availability of collateral, marketability of collateral, enforceability of collateral. We discussed one by one. What do you understand by the availability? Why it is important? Can anybody suggest here? Why we think that collateral should be available? Why it is important?
To minimize the risk.
To minimize the risk, yes. That's like, that's true. But why we think available? You mean to say that there are chances that collaterals are dummy or fraudulent situations? Is it? Yes, there are some occasions, created by interested parties to show the bank, right, as a dummy. Means that there may be documents. But there's no actual land. So that's why we always tell the relationship managers to visit the collateral prior to the credit approval. You need to go and ensure that physically collateral is available, land is available, access is there. That's why we say availability, very important. There are some occasions when customers are not going to pay. So you go to courts and auction, and when you're trying to plan legal action, there's no such collateral been mortgage. Documents has been created, right? So whatever mortgage bond and everything you've done based on documents, deed or plan or whatever extracts and all that there, but maybe fraudulent. What is the issue? You haven't checked it. So that's why it's availability is very important. Part one. Number two, marketability. Why it is important? Why marketability is important? Any examples? Marketability.
If the customer is not willing to repay, is the collateral is valued more than the payment should be done, like how to recover the amount to be recovered can be recovered from the value of the collateral is to be measured has to be done.
Yes, exactly correct. Spot on. Because marketability is, yes, we say that we are not going to go behind the collateral, go for the auction. All these things are correct. But in case of a requirement, in case of this unfortunate situation, if we need to go to sell this property, then it has the marketability. Right? What I'm telling is, let's say now you have been offered by the particular borrower maybe 10 perch square facing to main road land versus some agricultural land with 5-acre land, which is bit away from the main roads. Maybe same value, we say 5 million. What do you prefer? Or what do you think, which is more marketable? This 10 perch square extent facing main road or bit of remotely located 5-acre agri land? What do you think? Which is more marketable? කාටද කියන්න පුළුවන්? මොකද්ද marketable ඒ දෙකෙන් වැඩි?
The land which is facing to the main road.
Right. Because one thing is, facing main road, value could be increasing, and you can find so many buyers because it's a small, whatever 10 perch compared to 5-acre maintenance, and those things will be difficult, whoever who is going to purchase. So you get the point, right? So marketability is like that. එහෙම නැත්නම් අපි හිතමු there is a land located within a village and the land located in a commercial area. Commercial in the sense land located in a more commercial value is there. ඒ වගේ වෙලාවක you prefer go for the valley with more commercial oriented, right? Because if the land is located in a village, and in case if you want to go to auction that, which is not easy, right? Even have the access to that kind of a property in case of a unfortunate situation may not be easy, villages may not be willing to accommodate you. වෙන ප්‍රශ්න ඉන්න පුළුවන් අපි මේ වගේ තැනකට ගිහිල්ලා ඒක achieve කරනකොට. Right? So the important things are marketability. How marketable is. Enforceability. What is the enforceability? Enforceability. What is this enforceability? It means how soon that you can enforce the contract in case of emergency. If you take letter of set off, lien no fixed deposit, which is the easiest way. Easily you can, over the counter, you can uplift the deposit and do the needful. Whereas you have done a mobile mortgage form, which is very difficult to enforce in courts. Even a third-party mortgage, difficult to enforce. So many legal documents, has to be very accurate. I mean, lot of things that you need to look into. That's what we call about availability, marketability, and enforceability. Important things that you need to keep when you obtain collateral as security. In shorter, we call ever easy to value, and there should be a value, easy to charge, that enforceability, and realizable also. Right? Easy to charge is something, the easiness of the getting the documentation. Realizable is something, when you want to sell it like that, quick realization. Right? Easy to value, valuable, easy to charge, realizable. So those are the 4 things that we need to look into. Easy to value, valuable, easy to charge, realizable. Right. Any question?
Easy to charge is something
like
what we have
easy to charge, like let's say letter of set off, getting a letter of set off is easy, right? And let's say getting a mortgage one, it's a bit difficult, like execution of the mortgage kind of thing. That's what means that let's say if you want to do a cashback facility, you just get the deposit and you lien it. එතකොට ඒකට documentation ලේසි, එහෙම නැත්නම් ඒකට කාලයක් ලේසි, effort එක ලේසි. In case of enforceability උනත් ඒක ගත්තොත් easy, over the counter you can do. ඒක අපි easy to charge කියලා කියන්නේ. But when you are trying to do a mortgage bond, when you are trying to do mobile bond, it is not easy to charge because there are so many documents to be there, and signatures, validations, verification, ගොඩක් ඒවා කරලා තමයි ඔයා ඒ document එක හදාගන්නේ. Right? So then even the enforceability level also, it takes time. There may be injunction, there may be objections kind of thing. So that's why we say easy to charge in both things. It is in line with enforceability. Is it okay? තේරුණාද ඒක? not clear.
Yes, sir.
Realizable.
Yes, we can
realize කරගන්න පුළුවන් වෙන්න ඕනේ කියන එක තමයි realizable කියලා කියන්නේ. Basically there should be a value underlying that, and again there's a chance of realization. But some, you might say, if you take stocks for example, sometimes the stock may not be realizable as cash, as stocks. Realization again, we might have some issues. So then cash is better than stocks, checks is better than stocks, the realization value. Okay. Then value of the collateral. As a general rule, the current value of the collateral must give sufficient margin over the amount of advance, or rate of advance. What do you mean by that? Let's say if you try to give a loan to a customer and the loan amount say X, and there should be an asset cover to cover the particular loan. Say you have a 10 million worth security, and then you have a 7 million worth loan, then you have more than one time coverage from the collateral. And if you say otherwise, if you have 7 million worth loan, and if you have 5 million worth security, means that the collateral cover is less than 1. So you need to decide how much you need to have it. From bank to bank, there may be different requirement to maintain the asset or collateral cover. Some would say 70%, some would say 80%, like that. So you need to say or maintain that particular collateral cover when you are extending credit, right? It's like sometimes, you know, the collateral have different values. One has market value, wholesale value, insurance value. Maybe the valuer would give different values for us. For the computation of asset cover, we take wholesale value. Say, what we are generally tell is, say, out of the wholesale value, we take 70% of that should be equal to the loan value. That's what we say. Then we say we are adequately covered. Some bank would, you know, come into in a different way. Rather than taking 70%, they will take wholesale value divided by loan amount. It's something 1 point something. It should be 1.25 or more. That's what they say. Either way is correct. It basically depends on how you interpret. Ideally, security should rise in value because the risk involved in lending increases with time. Ideally, security should rise in value because the risk involved in lending increases with time. Because when you say the longer tenor loans, your repayment is to be done over a period of time, and then security value should increase. Exactly happening in property. Over a period of time, value of the property will increase as against the loan value. So loan to value ratio initially may be at say 80%, and it could be like increase to more than that. Consider whether there will be reduction of value of the collateral during the loan period. That is important thing you need to know. There are probability even some property values could come down over a period of time due to various reasons. So as a credit officer, you need to be aware with those type of changes because it is important. Otherwise, your loan exposure, like the asset cover, may not be prevail as you expected. Best practice to relate the nature of the collateral to the nature of the risk the bank has to undergo. Generally, we need to understand, you know, what type of collateral we are getting. Let's say cashback OD, cashback loans, owning advances, OD back facilities, like that. So depending on the product, so we can match the collateral. Example, it's something about short term, so we can link it to checks, stocks, because it's short term. Realization coming in short term also. But housing loan, term loan, obviously you need to link it to property over a period of time because longer tenor, high risk. In most cases, the property value increase in general. So we have a better collateral cover. Right. Then we come to the last one is a condition. Because condition, there are several things that we need to learn here. In addition to conditions of the loan, we need to see the condition of the environment. Like what could be the market condition, environmental condition, legal condition, technical condition, and those things also to be considered while you are assessing the customer business. Hope you are getting me. Now condition කිව්වහම ඒක loan related condition විතරක් නෙවෙයි. Which you are trying to learn here from this side onwards are loan related condition. In addition to that, there are other conditions could govern the success of the business. Suppose a particular entrepreneur wanted to continue the business, but he may or she find it difficulty in continuation of the business due to competition. And that's a market condition. Or there may be outdated technology. That's a technical condition. Or there may be some government is coming and putting some taxes, duties. So that's about a government coming and telling conditions like political. Or the government is putting some regulation, stopping some businesses. Then the legal requirements. Environmental authorities could come down and impose some condition, environmental condition. So means there are several conditions you need to check whether there is an impact to the business or there's not an impact to the business. Very important. So these are the conditions govern the particular entrepreneur and his business. That's one. Number two conditions are a credit facility itself, loan facility itself. There are several conditions. Example, the purpose, very important. Purpose of the credit, purpose of the loan. Banker, credit officer should ensure the purpose of the lending. The purpose, the end use, purpose of the loan proceeds should ensure the money is for the exact purpose. At that time, when you give a OD for working capital, the risk here is he can or cannot use the money for the intended purpose. Working capital කියලා ඒ ටික අරගෙන he can put it into purchase a land to give to settle a loan obtained from his friend. So means mismatch of approving authority's purpose and utilization. So it's important. Then bankers have their lending policies related to purpose for which they lend. Because then also we need to ensure loans being granted as per the bank's credit policy. Example, priority sector lending. So the government might advise, in turns, bank has put say 10% agri lending to be maintained. So it's a condition that you need to fulfill, comply. No lending to speculative purposes, repay existing debts. It could be high risk because it's a kind of a condition put forward by or agreed upon by the bank. Then another type of condition that you need to be worried with. No lending to illegal activities, right? It's a condition. It's maybe agreed by central bank to, and like that. So you need to ensure the purpose. That's number one. Number two, in line with lending policies. Again, there are some conditions. Then another condition could be interest rates and the profit margin. That you need to ensure, because why you are doing this business is lending. You need to earn profit, right? While minimizing the risk. So interest rates are very important, and margin of profit also important, right? Priority sector may attract low rate of interest and less or no commission, like agree. So sometimes there are mandatory lending rates. So sometimes you need to commit for those directions, whether it's attractive to you or not, but it's a kind of a command direction. But vice versa, there may be bank also can take some calls on other type of borrowings. Maybe secured loan, you can offer low rate. Unsecured loan, you can offer a high rate. Or maybe risky sector, high interest rate. Risky borrower, high interest rate. Existing, very good regular from customer can offer low rates. So like that, there may be different method of applying interest rates. And also the profit margin is very important, because some cases you can't manage adequate profit, but some contracts you can. As a portfolio, as a pool, you can achieve your lending target while also achieving the profitability target by applying correct interest rates on correct contracts. So first condition could be purpose, second condition could be interest rates and profit margin. Then the repayment terms also very important, right? Important for bank in order to ensure the proper repayment. We are trying to do these things. Calculate the repayment with interest, because whenever a customer is asked to repay, he has to repay debt plus the interest, or the capital plus the interest. Number two, obtain evidence for source of repayment. Very important. Now, when you say a customer can repay, you need to have evidence. It's through regular profit, it's through working capital cash flow, it's through other income, but we need to ensure the proper sources also. And ඒකතුව දැන් අපි මෙච්චරයා පේ කරනවා කියලා DSCR එක හදලා හරියන්නේ නැහැ. අපිට source එක පෙන්න ගන්න බැරි. Okay, if we can't exactly put the source, and then we might have some issue. Then the deduct customers outgoing from his source of income. Disposable income is very important, because there may be some expenses, customer liabilities, as against the income that he is generating, right? And you need to compute that to understand. Ensure balance is sufficient to pay. That's what we say DSCR. When you are trying to do some computations in terms of repayment, assessing the repayment capacity, you say this is the income, this is the deductible, this is the disposable, or whatever take home income, or the loan, or the amount available for loan servicing. And then you see whether the client can repay the debt. So DSCR of this much or that much, then we will tell like that. So the third one is the repayment terms. Very important part here, excuse me. Banker should ensure that the source of repayment directly comes to the bank. මොකක්ද ඒ කියන්නේ? What do you mean by that? Why this is important? Any example? This one. Ensure source of repayment. Any example? There are so many examples, but one of you can suggest. Kian Balanga, Hashani, Ushan, Erang, Chatura. Any example that come to your mind? When we approve a loan, we ask the source of income to come to our bank. Any example? Any example? Let's say if you want to go to personal loan, what they tell you? Route what to the particular bank? What they ask? Anjani?
Salary slip.
Salary. They wanted us to route the monthly salary to the particular bank. Why? That is a source.
If you are granting a pension loan, we just ask them to transfer the pension to our bank.
Yeah, very correct. Why? Because we need to know the source of repayment, source of income, source of repayment. When you approve a business loan, what we are trying to tell them? We need them to route their cash flows, route the business turnover, open a sinking fund, cash build up, right? Put all checks through our counters. Why? Because we want to ensure the source of income is got hold of it and routing through us. So then we know our repayments are also done through this. So very important in terms of capture cash flows and repayment. Then nature of the facility and the time scale for repayment should link with purpose. So that's why we are trying to do in most working capital facility. Because when we approve credit, that's why even the other day I was telling you, you try to provide the proper working capital facility for the to finance in the a proper item, which is a stock. It is good that you use factoring. Sorry, if you use a short-term loan, import loan, packing credit loan. So basically, it's relevant to stock financing. It's a debtor. It could be PDC, factoring, or invoice discounting, bill discounting, because it's relevant to debtor financing. So you are trying to match it with the underlying asset. Realization of the asset will automatically settle that. So then, very rare that you are doing bad. You are doing wrong thing, right? Last one, consider lending to those who provide good security, but who doesn't have got resource to, very important, right? So sometimes we might tend to approve credit for the people who provide very good security. You say, boss, we have a very good land, good property, 50% of the land, why not we give? No, that's wrong. Always think about first way out, cash flows. Client should ensure that he or she generates adequate cash flows to service the debt. Then, second way out could be a collateral. Yes, good to have a collateral in case of emergency, in case of customer commitment, in case to have more obligation from the customer. Yeah, it's good to have, but it's not always correct, right, to go behind the collateral. Okay, it's good to have collateral, but it's not the priority requirement. Then last one. So once you do the retail or individual credit assessment, so now we are in a position to assess the customer creditworthiness, customer credit requirement. Now you know BCS model. When you want to practice the BCS model, 5Cs could be a very good tool. අර දැන් මම කිව්වේ බරෝව ඉන්නවා ක්‍රෙඩිට් එක තියෙනවා සිකියුරිටි එක මෙතන තියෙනවා කියලා ඒ ටික ඉන්ටර්කනෙක්ට් කරලා බලන්න you can use this 5C model. Then it is complete. Right. Any questions? Any value additions that you can bring here? අපි අලුත් එකට යන්න කලින් මොනවද ඔයගලන්ට හිතෙන්නේ? එහෙම නැත්නම් මොනවද තියෙන ගැටලු? මොනවද ප්‍රශ්න ඔයගලන්ට තියෙන්නේ? Any thoughts? All clear? Good questions, නැද්ද? අචිනි, රංග, ආශිනි, උෂාන්, සම්මානි අද කතා කරේම නැහැ. Any questions? All clear? Because those are important in case if you are supposed to write questions, so may have good questions on those areas. Maybe then we need to discuss a bit of risk and risk assessment, but those are not very much relevant for the credit. But I wanted to give an idea on what is risk and that perspective also. But what we have done so far is very important for your even for examination that we are planning to have on you. Any questions? Hireshi, Kushan, Chatura, ප්‍රශ්න තියෙනවද නැත්නම්? All clear, all good? Okay, can we proceed then? Achini, Anjani, Madhushani, can we proceed? Hope everything is fine.
Yes, sir. No questions.
Right. Now we move to though it's not I'm not going to discuss in detail, but I think important area. But I will explain this part as well. So we don't have a proper model like 5Cs or 6Cs or Campari. Commercial credit evaluation, we are trying to do different things in order to assess the creditworthiness of the particular entity. The difference between the individual and the difference between the commercial entity is commercial entity is more established. They have more information and they have more structures, organization structure, right? Adequate people to run the business, not like individual customer running the business. And decisions have been taken more rationally, and it's in line with vision, mission, objectives of the company. And again, then a business organization එකක් ගත්තොත් a business organization එකක් evaluate කරන්න we can use different methods or techniques, though we don't have proper what do you call model, but I will tell you how we are going to do. First, we try to understand the environment. Let's say the particular company operating in an environment. So we try to do an environmental analysis. If you remember correct, under 5Cs, we try to do this environmental analysis under condition. So what the legal feasibility, political, regulatory, social, economical, technological. So we will try to understand what is this environment is going to do on the business. It's legally in line or not, politically, implications, regulatory requirements are being met, on the social impact, economical impact, technological impact. So like that, we try to understand the impact of the environment. Then if we see the impact of environment is positive, it's a support to the business. It's support to the credit request. If it is negative, we see it's a objection, it's a what do you call trouble, could be a risk to the business in terms of credit facility. Example, say a particular entity business is running a company and the technology is outdated. Now that means it's not a supporting. Or they are having a superior world-class technology means it's a supporting. එතකොට අපි තේරුම් ගන්න ඕනේ මේ environmental analysis එකකදී a particular entity එකට තියෙන්නේ positive impact එකක්ද negative impact එකක්ද? Either positive, we are pro towards the loan. It's a negative, we have some concerns towards the loan. එතකොට ඒක තමයි අපි මුලින්ම දැනගන්න ඕනේ. Then industry outlook. That's about market. What the performance of the market? Performance of the industry. Industry trends. Competition. Market share. Market growth. Market outlook. Market strategy. Marketing methods like advertising methods are coming under this industry and market. That's basically point 2 and 3 coming under 1. That's a market feasibility. Because if you again see the potential performance impact of the market is negative towards the business undertaken by the particular prospective borrower, then we see there is a market risk. Vice versa, we'll say the positive impact from the market. It's a highly competitive market out there. Means you should not encourage to give a loan, or you have to rethink on your loan proposition, or there may be counter proposition should come from the borrower in order to manage this competition. එහෙම නැත්නම් අපිට highly competitive එකකට අපි invest කරන්න they can't make adequate market margins. In return, very difficult to pay your debts. But whereas you have a better marketing strategies to manage the competition, then you are in a better position to achieve the desired results. Then the third one, financial quality, financial capability, financial feasibility. What do you mean by that? Whether the particular company, it is in good in terms of financial performance. It could be related to past, present, future. If you think that the company is not doing well in terms of financial performance and position, like P&L, balance sheet, cash flows, are acceptable or not. Why it is important? So we need to ensure that they are having adequate profitability, liquidity, gearing, efficiency, market performance, right? All those things should be acceptable. If not, you can't give a loan. Like earlier, under 5Cs, you check the capacity, cash flow. In the big picture, it's a financial quality, right? Fourth one is the managerial quality. That's the performance of the management, vision, mission, employee-employee relationship, experience, exposure, handling crisis situation, right? So all are important. Now earlier, maybe one person running the company. So you see his management capability. When come to here, there are a couple of people running the organization, and then they have different capacity. They are from different backgrounds: lawyer, marketeer, engineer, manager, and then we have to see their quality, their performance, their credit worthiness. අතන එක මිනිහගේ කැරක්ටර් එක බලනොත් මෙතන කැරක්ටර් එක බලනවා ගොඩක් අය. Okay, so basically what we are trying to do here is we need to ensure management feasibility, financial feasibility, market feasibility, environmental feasibility. ඔය හතර තමයි 4 pillars කියලා අපි කියන්නේ. When we are assessing these pillars using different tools available in the market, it could be SWOT analysis, pest analysis, Otis 5 forces model, product life cycle, financial tools. So there are so many things that you can use to assess these pillars. Once you assess these pillars, there may be positives, there may be negatives. You try to use these positives to minimize negative, and you do a structuring of the credit. Structure and collateral quality. There are 4 pillars. The 5th pillar is structuring the loan while attending the risk. Okay, so if you are good at analyzing these 4 pillars, then you are in a position to say that more positives, then you can move to support the credit. If you think that more negatives, then it's not a support the credit, could reject the credit facility. So the main difference between the individual loan to the commercial loan is more analysis, in-depth analysis, detailed analysis, complex analysis using different loan evaluation tools like SWOT, PESTEL, PCG, Otis 5 forces, 5 Cs of product life cycle. There are so many things available in the market. Okay, right. Any questions on individual loan analysis or the commercial loan analysis? Now it's up to you. Once you are very much comfortable, then we can move to the risk side. Any questions? You might have some questions on commercial loan. If any, please let me know. Any questions? All clear? Anjani, Madhushani, Iranga, Ushan, Sammani? Hireshi? All clear or any doubts? because most of you are not actively engaged in credit, so that's why I go into like very basic and discuss those things, because it's very useful whenever you have wanted to do kind of a credit type of job, or whenever you want to answer some kind of questions in case if they ask to. Okay, there's a question. Right, Anjani, thanks. Chatura, kom deranga. All good. Prashna good nadda.
Please.
Okay, thanks, Chatura. Hope the others also, because if you please let me know anything that you have some, because today is the last day. Later stage, if you do have any questions, you can contact me through my mobile or whatever, my email. But don't wait for that levels. But if you do have any questions, please let me know. We can clear whatever the any ambiguities, difficult areas, clarifications, so that we can continue without any doubts. Right. Okay. Now we move to a different area, which is not very lengthy, but I wanted to mention about this risk assessment in credit proposal. What is risk? So any activity in our life involves risk. Let's say if you want to do this thing, it could be something going wrong, it involves risk. Let's say in more practical situation, say Sri Lankan team going to match with another counterpart, and then if you want to make a kind of a gain out of that, you might say Sri Lankan team is going to win this match. For that I'm betting this much. That is the kind of activity that we are doing. If Sri Lankan team is going to lose, so you are losing. If they are going to win, you are gaining. So means if you want to do something, there may be some gain, similarly some loss, depending on the outcome. Now, when you say risk, so each activity of you are doing has some outcome, right? Activity, because you are trying to do something. Why? There may be outcome of that activity. Let's say you want to meet somebody, and for that you say you are going, but he may turn up or he may not turn up. If he turn up, then as planned, so you have done it, you have some gain with the transaction. If he's not going to do, if he's not going to turn up, then your time and your effort is in vain. There's a risk of not turning up also, whatever you said and done. So in general, risk do not disappear. They give users a choice, which to retain, which to share. No risk, no gain. That's a very popular saying. Why we need to understand this? Because let's say now customers coming to meet you. They want to do some financing with you. They want to take a loan from you. So you try to understand their business requirement while using available tools and assess the creditworthiness. So assuming they are good, you give a loan. You anticipate them to repay capital interest as expected. If they can't, then there is a risk. We call credit risk. What you can do here is you can say, I will give a facility or I won't give a facility at the inception. There is a choice. If you are shedding him, if you're not going to give facility, you lose your income. You lose a portfolio. That is the choice. There is a risk of lending. The risk can disappear when the risk is there. There may be, instead of this guy, you go for another one. Then another risk. So what is important is you need to understand this risk quantify this risk, level of this risk is important. Then there's an issue in assessment. Oh, if you give loans and everything being repaid timely, you are very much better, right? Because that's a gain, but you can't do it due to various other reasons that there may be chance of defaulting, right? That's how the credit basically goes on. But generally, risk is something it's the outcome of your action. Definition: probability of the unexpected happening, the probability of suffering a loss, because expectation is Sri Lanka team winning. Expectation is the borrower is paying without default. Expectation is a desired person turning up for your meeting. But unexpected happening means it's not taking place, right? Then there is a loss. There is a probability. The probability could be 1% to 2% to 10% to 15% to like that. Because of that, there is a loss. The probability of suffering loss is risk. It's a measure of probability and the consequence of not achieving the defined goal. How much is the probability? 1% to 2% to 10%? So based on that, it says the quantification of your risk. Say you have a customer. Now, probability of the customer not paying default, probability of default is 1%, 2%, 5%, 10%. 10% probability means higher loss. 1% probability is a lower loss. So the risk levels are different. We need to know which type of customers I am lending. As one of you asked, higher graded customers, higher rated customers. What could be the probability of default? It's a bigger amount or a small amount. And vice versa. It's an NPL customer. What could be the probability of default? High or low? Can somebody answer? I am trying to link in the rating. Grading of a customer with the probability of default and the risk. Let me know.
For NPA customer, high probability of default.
AAA customer?
Low probability of default.
So it means the obligo rating. We were discussing a little bit earlier. The dialogue, NSP, John Keels, low probability. Then risk is minimal. NPL customer, C-graded customer, age old customer, high probability, high risk of granting of credit. So that when it comes to the credit perspective, you understand what is the risk level. You can't avoid the risk, but you can minimize the risk by doing different things. අර මම කිව්වේ credit structure එකෙන් කරන්න පුළුවන්, collateral එකක් ගන්න එකෙන් කරන්න පුළුවන්, proper evaluation එකෙන් කරන්න පුළුවන්, risk එක පල්ලට ගේන්න පුළුවන්. Okay. Now, risk, RISK, stands for rare, incident, selection, and knock-in. Unexpected outcome is the risk. Harini, which is if you are expecting that you are not giving the loan, unexpected. Your expectation is customer to repay. Is not repay is unexpected outcome, rare incident. Then selection is identification. But you should be able to identify the risk. Identify it. Then you have to measure it. Identification is not enough. NPL customer, early warning customer, MRL, management review customer, delinquent customer. So you need to identify මොන level වල deal කරන්නේ කියලා. Identify කරගත්තට විතරක් මදි. You need to measure it. The loss has to be measured. Through probability of default, there are some equations. You need to measure it. Once you measure, you need to monitor and control also. That's what risk is. Unexpected outcome and identify, measure, monitor, and controlling through risk framework. That's what we call risk. Any questions? Any questions? Any questions? Could be a bit difficult, or could be bit of complex components are there, but good to share those things because it's important. So risk involves two concepts: likelihood, impact. Likelihood that some problematical event will occur. Impact of event if it does occur. Hence, joint function of two: likelihood, impact. So likelihood is a probability. Impact is a quantitative. Say you bet with your friend, say Sri Lanka will win, and you bet 100,000 rupees. If Sri Lanka win, you get, instead of 100, 1 to 2, 200,000. If you lose 100,000 plus or some, and vice versa. But likelihood is, if winning, impact is high. Likelihood is losing, impact could not be that great, because based on your agreement, right? Because Sri Lanka these days not doing very well, so probably you say win, and if it's a win, say 1 to 10, you put 100,000, you get 1 million. It's a win. But lose, obvious lose, so you say 100. If the win is 10 times, if the lose is, you put 2 times or what something. But again, you're losing. Sorry, it's something about 50% of that. So 50,000 you are losing. Impact is lower because in general, Sri Lanka is losing these days. But it's a win, you get something. That's a risk you are getting. There may be chances, right? But you try, you bet for a win, which is very remote these days. But you take a risk of that, right? You lose, you only lose 50,000. Say 100,000. 100,000. If you lose 100,000. If you win, instead of 100, you get 1 million. So what try කරලා බලනවා Sri Lanka team එක දිනනවා කියලා. Right? So the likelihood is a probability, impact is the outcome in monetary value. So two things: qualitative, quantitative. The function of that will be the outcome of the risk. So there may be chances where likelihood would be very less, but impact would be very high. Eighth risk is high. Example: happening tsunami. Likelihood is less than 1%, but impact of happening is billions. You getting my point? So then the multiplication of this, when you say, when these two things get together, risk is very high. Okay, vice versa. Then impact is very low, likelihood is very high. Cashback NPL customer defaulting, likelihood is 100%, but impact is near zero because you have cashback security. Then risk is minimal. So like that, you case by case, you need to see what is the likelihood and what is the impact. other elements of risk. So cause of the risk factors, hazard, and the safeguard. In risk management, what we are trying to do is we identify these hazards and allow safeguards to be developed, overcome them. ඒක තමයි අපි කියන්නේ risk identification and risk mitigation. In lending, what we are trying to do is මම කිව්වේ 4 pillars පාවිච්චි කරලා if it is positive, those are the mitigants. If it is negative, those are the hazards or the risk. So we try to use the mitigants, to manage this hazard. It's another way you look into risk, managing the risk. Like let's say, in case if you see higher competition in a given business, it's a hazard, it's a danger. Mitigant could be financial capacity. You use that safeguard of financial capacity, adequate net worth, adequate money to mitigate the competition. Risk. That's why we see it in a different way. So overall, if you see this, probability, impact. Right? If you say higher probability, higher impact, then you have high risk right here. Like if you both are high, here, this is how the risk is coming here. If the probability is low, again, you have here. The impact is low, you are end up here. If both are increasing, you are here. It's a high risk. If both are averaging, it's moderate. Both are low, it's a low risk. So here, low risk, here moderate risk, here high risk. High risk in the sense impact is high, probability is high. Impact is low, probability is low, you are parking here, you are basing here, locating here. So when you are assessing the customer needs, also you need to see whether the customer's proposition, particular business request, credit request, project request, it as high risk level, moderate risk level, or low risk level. If it is high risk level, yes, you need to get some adequate mitigants, collateral to whatever, price into and all that. Still, if you are unable to do it, so you might drop the facility. Right. Then credit worthiness versus the credit risk. Because now earlier we were trying to use a couple of models, 5Cs, 6Cs, to assess the customer credit worthiness. And the corporate commercial credit evaluations also, we use some methods to understand customer or business credit worthiness. Then if you found out the customer credit worthiness is low, then obviously risk is high. And credit worthiness is high, obviously credit risk is low. Right? So credit worthiness versus credit risk is a relationship where low credit worthy, high risk. High credit worthy, low risk. Remember, that's why we say NPL customer will say defaulting, high credit risk. AAA company, low credit risk, no defaulting. Here, the credit worthiness is respect to a borrower. And now you have products, now you have security to manage this credit risk in different methods. So අපි BCS model කියලා ඉගෙන ගන්න එකේදී අපි කරන්නේ මේ risk එක manage කරන එක තව විදිහකට. Structuring වලින් හරි, securities වලින් හරි, terms and condition වලින් හරි. දැන් අපි ඉගෙන ගත්ත model හැම එකේම what we want to do, we want to first assess the credit worthiness, and assessing the credit worthiness, minimize the credit risk attached to that. Then only we will end up with the successful credit transaction. Right. Then important part is the management of credit risk. What do you understand by this management of credit risk? Because we were talking about identifying, measuring, controlling, reviewing. No? So very important part that I am going to discuss here. Management. Assessment of credit risk. Very important. Through 5Cs or 6Cs or other tools, other assessment tools, you need to understand, identify what is the risk attached to this particular customer or credit. Similarly, you need to understand what are the safeguards, what are the mitigants, risk and mitigant, hazard and safeguards. Say, when you understand, when you evaluate the market feasibility, competition or related lack of experience in market are hazards. Maybe the durable product, branded product, good dealer network are safeguards. Right? එතකොට ඒ දෙක map කරලා අපිට පුළුවන් minimize කරන්න credit risk එක. So assessment is key. Then mitigation or reduction. Once you assess, once you identify, then you reduce. You try to put some controls. Reducing hazards, increasing safeguards, cushioning the risk through collateral, putting some terms and conditions, introducing collateral, and using the safeguards to minimize the hazards. So that's what you're trying to do. So mitigation and reduction of credit risk is number 2. Then controlling and monitoring, 3rd and 4th. Follow-up and supervision, pre-post becoming. So pre-approval and post-approval. So pre-approval, you can do so many things like this assessment to control, monitor the credit risk, to put condition and all those things. Post-approval, there are maybe equal number of activities you can do. Inspection, meetings, visits, rolling stock reports, financial reports, industry reports, so many things. So assessment, identification, that's number 1. Then you put measuring and mitigation, reductioning, controlling and monitoring. These are the ways and means of managing the credit risk. Then last one, managing the credit portfolio and NPA portfolio and impairment as well. So many things you do by credit department, by business itself, branches, finance department. So all together, so everybody together, we do what? Management of credit portfolio. Because credit portfolio you are managing, so without concentration, without any sectoral issues, because it could lead to credit risk in later stage. So many reports, MIS reports, follow-ups and all that. When go to the non-performing advances also, you do so many other things to manage the portfolio. About NPL, provisioning, impairment and all that. By doing these things, you are in a position to manage your credit risk into greater level. So this basically, we try to understand what is risk, how it is being identified, measured, control, review, what are the functions of credit risk, and why it is kind of important, and what's the link between credit risk versus creditworthiness, and how we are going to manage the credit risk is basically what we have learned so far. Any questions? Any questions? Any questions? It's up to you. Any questions? All right. Anjani has asked measuring tools. Yeah, Anjani, measuring tools are like provisioning, like impairment, central bank provisioning, NPL levels, collection ratios, infection ratios are some of the tools, say, to measure the credit risk, which is very much frequently used. But there are some technical tools like I mentioned about probability of default, and then there is another thing called loss given default and exposure at default. So we try to use probability of default, loss given default, exposure default, and we multiply these three and say this is our exposure at risk. Advanced, which is coming under the Basel, but the rest is like we do at credit risk level generally about NPL, provisioning, impairment, bucket movement, and yeah, those things are generally we say measure. If NPL is high, we say credit risk is high. If impairment is high, we say credit risk is high. So bucket movement is high, we say it's a credit risk is there. Like those are some day-to-day things. But when come to the Basel and maybe more PNL related information, we try to use this exposure at default, loss given default, and probability of default. Together, we multiply and see this is our loss, credit loss. And you, based on that, you do capital provisioning and you do further PNL provisioning. එතකොට ඒ ටික තමයි පාවිච්චි කරන්නේ credit risk එක measure කරන්න. Any other questions? This is basically now what we have done so far is we have understood who is borrower, what is credit, what is security, and what is the interconnection between BCS, and then what are the methods available to interconnect these BCS for individual customers and corporate customers. And finally, we discuss about what is risk and how we are going to minimize or mitigate risk when granting credit. So that's what we, in very summarily, we learn. Another aspect of lending is once we give a loan, there's a likelihood that some of these facilities are not repaid as expected. Hence that they could go bad loan, problem loan, NPL. So different terminology is being used. We try to understand why this is happening. Why the performing loan becoming non-performing, right? Or problem category, problem loan. Because a problem loan is a facility which carries the above normal risk. Now, each loan, as we discussed earlier, will have a risk. Okay? But some loans carries above normal risk. Again, then api normally තියෙනවනේ ඕනම එකක risk එකක්. ඒකනේ mitigate කරගෙන අපි කරගෙන යන්නේ. ඒතර එතනින් එහාට super normal profit වගේ above normal risk එකක් එන්න පුළුවන්. How it happens is borrowers' creditworthiness has deteriorated to the extent they are distressed or insolvent to meet the obligation. Now, we have a creditworthiness assessed at the time of granting, and over a period of time, it can deteriorate. It can deteriorate to the extent commitments couldn't pay it. Adverse development and circumstances arise or adverse information, inability to meet their obligation. Then there may be an environment is being created, like right now, COVID example. So inability to meet their obligation, that again is a problem category. Then extraordinary circumstances also possible about tsunami, fraud, economy, government policies. Again, extraordinary circumstances also could happen, and as a result, the above normal risk could take place. So 3 categories, 3 inputs. So in case of problem loans, what we're trying to do is we try to identify, like risk, we try to identify these problem loans, because identification is very key. If we are not able to identify, then we are unable to treat, manage them, or even later control them. So how we can identify these things? There are so many methods. I have given some more features here because this could be important for exam. That's why I just wanted to share this with you. Once you grant a loan to a customer, credit facility to a customer, observing the performance of the borrower, you can identify the problem status, like hard coding, check returns. What are those? So there may be chances where OD become hard code, check return. Loan repayments, default. Asking continuous excesses above the approved limit. Unclear defects, borrow against that. In terms of operational perspective, bad debts, stocks levels going up, creditor payment delayed, then order book coming down, cancellation of orders by the prospective customers, buyers. Now the customers are supposed to provide the business financials, which are not happening appropriately. Then they depart from one business line to another business which are unrelated. One product concentration or one buyer concentration means that you don't have many buyers, only one buyer, or only one product. When you are concentrate one product, one buyer, what happens is if the buyer is going to operate well with you, obvious problems. Then one product is something, product failure, you lose everything. Then extravagance in personal life, very important. Now, maybe a customer at the inception, coming to meet you through a mobile, and later now you see that it has been, escalated, or improved to some kind of a small van. And now you can see the client is now moved to like bigger Jeep. And also you can see he's spending like nothing for his sort of personal and so many things. Or flamboyant management style is another one. Like you see, there's no control on expenses kind of thing. And so these are some of the things one can identify of a problem. Now, if you see these things happening with respect to your customers, you need to be alert. How you are going to find out these things? These things could be found out through bank database system, and also you can find out this information by visiting meeting customers. Also, you can get those information from outside sources like gossip, papers, maybe outside. So there may be different sources that you can identify to get this information. Important is continuous follow-up, because by doing so only you are in a position to understand whether the particular facility not doing well. If not, what happened? Until the client facing the bankruptcy level, you get to know client can't repay, client can't run the business. But identify these problem signals earlier, which gives you better stage to understand remedial actions. Now we move to that. Before that, we try to elaborate some of the identification signals with detail so that you can get a better perspective. Unusual, unexplained. Delays in receiving from his financial reports and payments in communicating with bank personnel. Because now every quarter, some customers are supposed to submit quarterly financials. But now you can see these things are not happening. And when you inquire, there's no proper justification for that. Means some issue. Also, sometimes you see they are going to change the accounting method. Depreciation, or maybe revaluation reserve, maybe bad debts, provisioning, right? Then if they are going to change the methods, accounting policies, accounting principles, you need to be a bit careful. Third one, restructuring outstanding debt or eliminating dividends, experience a change in the customer credit rating. Very good. Now, if you see that, restructuring debts, customer credit rating is going to change, dividend eliminations are some signals you can identify to show, to say that client is not doing well. Adverse changes in the price of a borrowing customer stock. Adverse changes in the price of a borrowing customer stock.
Excuse me, sir.
Yeah,
these problems is discussing before we evaluating the customer or after we giving the loan.
These problem loans are basically happens is like we do a BCS model through 5 CEO commercial loan evaluation. We grant credit while minimizing the risk. That's why the part 1, part 2, and part 3. Now you have given. Now you see the client showing some bad signals, problem signals. Then we are trying to identify the sources, features of problem loans. Why? By doing so, we can minimize the impact. We can do early provisioning. We can take legal action. We can do restructures. I mean, so many things, because otherwise, as I mentioning under the credit risk, higher NPA is a credit risk measurement. Higher provisioning is a loss to the bank. So you need to avoid those things by proper identification and providing adequate support to these problem customers to bring back to the performing level. Is it clear?
Yes, sir, clear.
Then net earning losses in 1 or more years, because sometimes you see when the customer is submitting financials up to particular year, they're showing some profitable numbers. So beyond that, you can see the profitability is now going negative. Net worth is now eroding. Return on equity, return on assets, return on investments are coming down. So some problems taking place in the business. And maybe debt equity level, liquidity efficiency, gearing, right? I mean, so many things now you see are deteriorating in terms of financial balance sheet, P&L, cash flow statement. Deviation of actual sales from the budgeted. Because when the loan is going to approve, at the time of the loan approved, you may have planned future sales. Now you see those are now deviating heavily. Then there may be some issue because 100, 120, 150 was your original plan. Based on that, you say cash flows and then repayments on the proposed loan. Instead of 100, 120, 140, now 100, 105, 110 like that. So sales now come down. Obviously, then cash flows are not sufficient to cover the debts. Sudden, unexpected, and unexplained changes in deposit balances maintained by the customer. Now, normally, maybe sinking funds, fixed deposits, other deposits. Now you can see it's bit changing irregularly. You can't, explain. You can't explain a particular reason for that. So due to various reasons. So you need to be vigilant. Then we identify. There's a kind of a checklist, and then we also see some features in detail on these problem loans. Now what we are going to do? Right. The most important thing is how we are going to handle it. Because having said that the customer is in difficulty, you can't let him to go to NPL. No? You can't let him go to bad loan. No? Legal action cannot be taken. No? It's not the right way to do. Now you need to help the particular customers. How we are going to do that? This is what we say, handling problem loans. Let's see how we are going to do that. Always keep the goal of loan workouts firmly in mind to maximize the bank's chances for the full recovery of its funds. Always keep the goal of loan workouts firmly in mind to maximize the bank's chances for the full recovery. Because now, what is your main objective is to recover your loan fully. So all your workouts, actions to be aimed for that final goal. That's one. Number two, as much as possible, you need to detect the issue rather than postpone. If you see some issue in the customer, as we have listed earlier, you need to take action. Visit, discuss, offering solution, restructure, reschedulement, getting adequate collateral, attending some conditions, because further deterioration means there's a difficulty in returning. Third one, keep the loan workout responsibility separate from the lending function. Conflict of interest. Because there may be some credit officers, branch, business unit, they have approved the original loan. And again, if you are going to do the recovery function on rehabilitation, restructures, loan workout, may not be easy because you have a smooth relationship. But with recovery, you can't be always smooth. You need to take some hard actions, hard calls, tough, relationship, tough address. So then, when you are trying to do those things, it is better that you keep that handling the customer by two parties, not the original lending officer to do everything. There may be a recovery specialist, rehabilitation specialist. These are the things that they have to do. Possible options, whether what they could do, like expenses reduction, cash flow increase, management control. So those are the things that one can do immediately. Because let's say, right, you are now trying to help him out to come back from the situation. Then, without further delay, you need to do expenses reduction, increase cash flows, cutting expenses. So like that, those actions, early actions could be useful. And then you need to discuss with the customer in detail. The situation is not like earlier. Earlier, at the inception, new loan is a very good picture, all positive. But now, things has been now rosy, change, difficult to manage. Hence that you have to one-to-one detailed discussion to understand the problem while offering the proper solution. Always you need to see about the quality of the documentation, quality of the mortgage bond, documentation in order, any kind of claims that we are supposed to get, and whether we are in position to minimize those claims. Because always you need to have it, yes, end in mind, loan recovery, and until you reach that level, you have to do everything possible to minimize the damage while safeguarding both customer and the bank interest. Fifth one, estimate what resources are available to collect the trouble loan, including the estimated liquidation value of the asset and deposit. Because now let's say you approved a loan, he has been paying up to some level, now it is in arrears, it's liquidated level, unable to pay. There may be some assets which has been mortgaged to you, and some assets which are freehold, not mortgaged to anything, and make a kind of, say, asset versus liability. What we can realize at this point of time, and if it is so, how much is that amount? Get an idea, because then in case of liquidation, how much we can get, how much we need to get, what's the gap? It's a big one, small one, like that. And 6, loan workout personnel should conduct a tax and litigation search, like unpaid obligation. It's very important. There may be unpaid obligations towards the tax authorities, litigation purposes. So whether you are willing or not, you need to pay them also. If it is government related, it's like tax authorities. So you need to have an account for that liabilities as well. 7, business borrowers, bank loan personnel must evaluate the quality, competence, and the integrity of current management. Visit the sites, assess borrower's property and operation. Very important, because now it's not an individual, it's a business borrower. There may be management change, right? There may be new directors, new people running the organization. Now you have to reassess their competency, quality, capacity, commitment. Because now, based on that, only you have to take some future actions. Sometimes you need to visit the premises and meet, observe the operations, to meet the the people there, and get an first-hand information, idea. So then only you get a better understanding, right? And then you can say, right, so based on that, yes, you can handle the facility. Then point 8, all reasonable alternatives clearing up the troubled loan, including making a new temporary agreement if loan problems appear to be short-term in nature. Say, if you think that this is not a long-term issue, like COVID, for example, the central bank allowed us to offer moratorium because we presume it's a short-term phenomena. It's not a long-term, because until country is open, country back in operation, 6 to 9 to 12 months kind of grace period, both capital and interest were given to these customers. But there may be some customers, you can't make them a short-term solution. Then it could be rehabilitation, restructure, reschedulement kind of thing, which is long-term. So you need to understand that. If it is short-term, yes, you have to do it and support the customer. Or finding a way to help the customer strengthen cash flows, or to infuse new capital into the business, like short-term solution. In other words, also you can find or give alternatives, give support by way of strengthening the cash flows. How? Cost cutting, selling of some unearned assets, reducing some operations, reducing some staff, because for the time being, you can't do the business like you were doing before. So the best thing is you curtail operations while curtailing resources, and then later you can go back to the original levels. Okay, so what we need to do is, like, you need to understand all possible solutions, alternatives, and then step by step you need to implement short term, medium term, long term. Third one, other possibilities include finding additional collateral, securing endorsements or guarantees, reorganizing, merging or liquidating the firm, or filing a bankruptcy petition. So, like, let's say short, medium, and some solution, yes, you do. Still, some things are not happening your way, then you need to do different things. Like maybe your WCU exposure are not adequately covered with the existing collateral. So then you find additional collateral. Or you need to take maybe third party or corporate or kind of guarantees. Or reorganize the kind of business operation. You need to merge with another entity, or maybe liquidate the firm and move out of the business, or maybe bring an investor to a business. Right? So bit of strategic level things you may have to do. If small things, average things are not working, then filing the bankruptcy petition. Finally, if things are not in your favor, if all alternatives are not happening positively, then you need to do a bankruptcy petition. Now, up to this level, you are trying to handle action by negotiations, right? So you can do restructure, you can do rehabilitation, loan workout, moratorium, extension. So all are a kind of a win-win situation. But sometimes we are unable to make things on a win-win basis, positive basis, because customers, they may acting like willful defaulters. They purposely they're not going to pay. So you need to understand those customers as well. For that, then you go to recovery. Again, soft to medium to hard. So in a soft to medium to hard recovery, the first step is like negotiation. You discuss with the customer and inform him. This is the way forward without going for the hard litigation activities, legal activities. It could be a solution where you try to give customer repay the debt in extended time horizon. So again, the objective here, like earlier, repayment is shortest possible time and recover the total outstanding. Because now, earlier, yes, loan workout, you need to keep your mind that, we need to do full recovery during this course of action. But when you are trying to do legal side recovery action, then you can't wait so long. You need to have a dedicated, identified some time horizon to say that we are going to recover outstanding in 2 years, 3 years, 4 years, like that. So probably we can do facility reschedulement, restructure, where we both parties sit and agree kind of a tenor, terms and condition, additional collateral, revisiting the loan covenants if possible. Right? So this is again win-win because we are not going to litigation. If you go to legal litigation, it involves with more time, money. We try to avoid that. And we plan to offer win-win again, because now earlier we talk about short-term, mid-term solutions, which are different things, failing which we are trying to do liquidation, legal action. Right? One of the recovery method is a restructure, reschedulement. Because in Sri Lanka, we don't have any separation between restructure and reschedulement. Ideally, reschedulement is something you reschedule the tenor. When you say restructure, you are trying to change not only the tenor, other aspects as well, right? Other conditions, covenants as well. But in Sri Lanka, we use both words simultaneously, restructure and reschedulement. Right? So let's say if a client, even after restructure or reschedule, is not going to pay, then you need to take some more actions that we call, I think I haven't mentioned those things here, right? There are so many recovery actions we can take. It could be parate action, it could be arbitrary, it could be debt recovery, it could be mortgage bond action, it could be what you call, remember this, Samatha Mandala, exactly, I'm getting the word. So like that, there are so many legal processes available for recovery purposes. If you do a parate, in order to do a parate, the property should be owned by borrower himself. The loan amount should be more than 5 million. The facility should be classified as NPL. If the facility is NPL, loan outstanding is more than 5 million, and the property is owned by the borrower itself or himself, we can take actions under parate principle, which is the easiest method to bank to recover dues through legal action or the auctioning. There are some other like debt recovery, money recovery, mortgage bond actions, so many other things. If the property owned by a third party, or if we have a mortgage over stocks, or if we have a personal guarantee against somebody, then we need to go other legal activities, which is a tedious and lengthy process in order to recover the dues. Right. Then, if you see the arbitration, Samatha Mandala kind of thing, where before going to the courts, you are trying to take some actions, which is again facilitate, which is again useful for both parties, borrowers and banks, without going to tedious and costly processes through courts to arrive some solutions. That is some of the activities available for a bank. So basically, what we are trying to learn here so far is we try to understand what is problem loans and what are the features or the identifications of the problem loans through some sources. Then we try to understand what are able to handle these things, soft to hard. What are the soft actions and what are the hard actions? It's good that you identify and you manage, identify and handle. But most important thing is how I want to manage, how we are going to manage these relationships. Before moving to non-performing, what can you do? That's the most important part. How to avoid problem loans. How to avoid problem credits. First one, monitoring daily inward excesses post debits on current accounts. Why? Because if the customer is operating the current account with your bank, and if you can closely monitor the account flow, business flow in the account, excesses, temporary overdrafts, hardcore status, cash flow levels, then you can figure out whether the client is facing any problems. So that's why we always encourage facility customers to route their business turnovers through a particular bank, because you don't see any issue when you are regular monitoring those relationship accounts. Suppose if you don't have that mechanism, what could be the scenario? If so, you don't know whether the customer's business is impacted, any issue, deteriorated, because he may be paying month-end dues by getting whatever methods he used, but you don't have hold. You don't have a control. So it's good that you do these activities regular basis. Second one, monitoring of overdue loans, bills, import loan, etc. That's very important. Monthly, there may be payments to be done. When you are monitoring those things, whether it's a paymaster or paying promptly or paying with delays, paying with reminders, so then you can get an idea. The client is doing good or bad. You keep on following. If you see some delays and all that, so you visit and get it clarified from the customer. Right? So many things that you can do. Loan covenants, terms and conditions. It's another important parameter. Because whenever you are going to approve a credit, you impose some terms and conditions to the credit. And you also impose some covenants, saying this much of cash to become, this much of business turnover to become, cash build up, submission of financials, submission of stock reports, and so many things. Now, when you are monitoring them monthly, quarterly, biannually, yearly, now you see some covenants be not met. Then you need to act on that fast. Why it's not happening? What is the issue? So there may be genuine reasons, and there may be willful. It's not adhering. You need to understand those things. Then regular collateral evaluation, very important, because every 4 years it's performing, you need to do evaluations. It is NPL. Yes, again you need to do evaluation. Why? Because you need to assess the status of the collateral. If the facility is in NPL, and if you haven't cross-checked, visited or validated the collateral status, you might have problems. Stock inspection, as and when required, if applicable, you need to undertake. Maybe the loan size is more than 25, 50 million. If you have taken stock as a mortgage, yes, you need to visit them. And you need to understand the stock position, understand the stock status, maybe deteriorating, maybe stock coming down, maybe piling up the stocks, right? So you need to understand those things. Regular visits, very important. So you need to visit depending on the project size, complexity. You can arrange your visits. It is a must. Whenever you are trying to do those things, project and business, all those visits, you try to get an idea about business operations, management of the business, and feedback from the buyer, supplier, and employees. Very important to know things. If you see even a small deviation, you'll be getting to know those implications. Then obtaining a financial information quarterly or annually. That is again important. Why? Because now, suppose if you have analyzed the customer based on the customer financials, historical financials, and then management financials also with you, then you need to see what the future forecast financials are, right? And based on that, you need to take some calls, whether financials has been deteriorated, profitability levels has been deteriorated, gearing has worse, efficiency levels has come down, ROI, ROE ratios has been impacted. So you know, because with these financials, quarterly or biannually, right? Then you get an idea Because if the customer is delaying that, customer is not submitting, then it's a question. Also, as mentioned earlier, once you get this, you can look for symptoms. But as a credit control, what you have to do is you have to get there timely. And customer also knowing that, no, I need to submit. I should, fulfill the terms and conditions. Internal risk rating. Earlier, somebody asked me, that is risk rating to be reviewed. Risk rating to be reviewed. Right? Because risk rating is another identification of your creditworthiness. If rating downgrading happening, its rating is downgraded, rating is not maintained as expected, then we need to see there may be some issue, need to address it. Review renewal of insurance policies, very important, because in case of emergency, insurance will come and support you. Stop maybe fire, the theft, but you need to review it and renew it at correct time. Facility reviews, very important. So depending on the credit type, you need to review the facility yearly, every 2 years, every 5 years, like that. So there may be review requirements given as your credit policy or procedure. So once you do this, you understand, you identify so many loopholes, negatives, problem areas. So what we are trying to understand here is problem loans, 3 areas. First one, identification. Second one, handling. Third one, controlling. So controlling is very key. If you do have proper controls, then performing to non-performing will be very less. And if you do identification using these problem signs, then again you can take early action under the handling category. When it comes to the handling category, you try to do is as much as possible in win-win proposition. Just giving calling, visiting, restructuring, rescheduling. You try to bring the customer back to the performing without bigger impact. If everything is failed, yes, then no alternative to go to the legal action, litigation. That is in very briefly what is loan recovery, follow-up, and legal action activities. Before moving to the checklist, any questions? What we have done so far? You can ask anything on what we discussed. Any questions?
Sir, after the session, that gives some things point of the exam, what type of, what kind of areas we should look for.
Sorry, may I think you please repeat the question? I didn't get it.
Can you sir explain the what kind of area especially we should looking for the exam after the session?
Right. So, any other questions on what we have done so far? Right. Achini, actually, I have not figured out any which area that I need to highlight, but I can, give a guarantee that, I am not asking anything beyond the presentations, what I have done. But what I'll do is like, I will, set some questions on key areas like, let's say 5 C's, commercial credit area, and best principles of lending, and maybe some recovery methods, identification of what do you call problem loans, methods of handling problem loans. Like, so I'll take, there are, very important areas that in presentation. So I will focus on those. But I can assure that, it is not like very difficult. But only thing is, I'm not also moving out from the presentation, right? What we have done. So we'll try to make sure that, everything what we discussed, not even like the things that I additionally given, everything I try to focus on to limit to the presentation itself. Again, there is also like, if you take collateral, what are the things that you would look into considering a collateral for facility, like enforceability, marketability, like that. Or maybe a question could be like, what do you mean understand by the marketability in the collateral? අන්න ඒ වගේ ප්‍රශ්න ටිකක් මම අහන්නම්. මොකද කොහොමත් මේ slides වලින් පිටට යන්නේ නැතුව ඒ slides වලත් important topics වලින් I will try to take some questions, because it's far away that when your exams are, I think this is the first 3 days of your course. There may be another 10 to 12 days to go. So based on that, so let's see how will be the live questions. But I will assure that the questions are not difficult, and not picking questions outside what we discussed here. Right? Any other questions?
Sir, how many questions come from your section?
I think there may be 2 or 3, maximum 3. I think I'm not exactly sure. Last time I think it was 2 or 3, but it could be 2, maximum 3. I think generally it could be 2, because there may be some other, there are 6-7 areas that you need to undertake, and then probably they will have also that altogether there may be 7 questions, I suppose. You are supposed to write 5. I am not exactly sure what the like composition of the exam. Yeah, Kimi.
Sir, this exam is a physical or online exam?
It should be physical, right? But these days they can't even think about. Earlier it was all physical exams. It was like even banking exams also they conducted physically. Can't be online. But probably I think if we are going this rate, this course period is for about 4 months or 6 months.
48 hours.
So this is 4 months, Menaka.
Right.
4 months.
Yeah, probably. Then if you go like this, something about June, July, August, September. So by the time then October also, we may be in a position to carry out the kind of physical test. So no, not a kind of big issue on the exam, because since that I highlighted sometimes, and you need to do these things, because just to get then to focus you on critical areas, and then don't think too much on that. But there are some very important areas on each presentation, so you can get an idea on those and be ready on that. Okay. Any other questions? Okay, so let's see the last area, credit collection policies checklist. This is basically out of what we plan to learn, and here is something could be important in case if you are actually doing a kind of a credit officer kind of a role, then you can use this, right? When say under credit approval, whether you are complying, you are fulfilling these areas. Like example, written application required for every credit request, standard form for application completed personally by the application, reviewed by completeness. So like that, this is something that you can check. Say you are a credit officer or you are a credit manager. Then when credit paper comes to you, right? So you can go through these items, whether the particular credit paper has been addressed adequately in these lines. Then there is a less likelihood that you missed most of the things, because in credit control also, even NPL management, risk management also, we can do some pre-approval activities. So the pre-approval activities are these sort of things, where you try to do a right thing, correct thing, before approving and disbursement of the credit. Then if you see any difficulty, if you see any issue in evaluating the credit, you are addressing before granting the credit. Then you figure it out after granting the credit, because it's then we don't have a control. But if we can do most of the things at pre-approval level, then we are in a better position to address most of the problem you're expecting later. Then invoices. When you are getting the invoices, these are the things that we want to check. Prompt, accurate, payment terms mentioned, customer special instruction followed, like that. So then terms of sale, statements, right? So these are the things that you need to do. When come to the problem of identification, like we have given a checklist earlier, so but when at the follow-up stage, you can do these things: collection period, average collection, current collection, and it's matched with your payment period, monthly agings of the borrowers, right? When once you identified your corrective action you have taken, and it's like concrete action or not, so like that. So in this way, you are doing a cross-checking of each activity of credit chain, from credit approval to credit monitoring. Right? This is good, especially for who are right now in credit job or credit officer role. So this could be useful. So you can enlarge, further enhance the content of this, and then you can use it for day-to-day activities. There's a follow-up. Sometimes once we approve, we do follow-up on accounts. Right? This follow-up is basically a credit control activity. When following up, you are trying to do these activities: systematic procedure, standard sequence, letters, telephone, techniques, like that, right? So these are the things that again could be useful, right? So with that, we are just completing today's session. Before winding up, I will share, just go through what we have done so far. It is good for everybody. Just to quickly, we will go through from 1 to 4. You can see the board, I suppose, right? Okay. Basically, part 1, we try to understand introduction to the credit, type of borrowers, and business sectors. So there we discuss about credit in terms of credit in terms of finance, commercial trade, and what is credit management in terms of banking. Then detail about the credit management. Why the credit is important to emerging economics, right? There are several things we discussed. So these are kind of probable questions, right? So why credit is important? What do you understand by the credit management? Maybe like small questions. Maybe you can get 5 marks by answering these. Then sources and users, right? Then we discuss about type of borrowers and business sectors. So there are several borrowers we discuss about, individuals or proprietorships and all that. But remember, always I told you, just in absolute perspective, there's a no meaning of say is an individual, it's a partnership, it's a sole proprietor. The importance is in the context of product, security, and in the environment the particular person is in, will tell you the creditworthiness, the nature of the particular borrower. That is what we were trying to discuss throughout these 4 lessons, where we try to see BCS: borrower, credit, and security. Then these are the type of credit available in banking book: consumer credit, commercial credit, development credit, international trade finance. These are the purpose of advances, right? So trade, housing, agri, industry, tourism, small scale, small and medium enterprises, micro enterprises, consumption. Like purpose, why, where we are giving loans. Very important. Under each, actually, we have given some subtopics also. So with that, the first actually session was over, right? So this is not a very difficult area, but this gives us a basic understanding about what is credit, what we do, what are the areas, what are the customers, and what are the sectors kind of thing. Then when we come to the part 2, then we try to learn about what are the lending principle and best practices. Very important area. Safety, liquidity, profitability, spread, purpose, end use, need-based finance, viability-based finance, own stake, national priority. Because these 10 are very important. So we try to do the lending activity by applying or using adopting these best practices. It is correct for whenever you undertake lending. So we learn in detail about each item. So probably you may require to list 1 or 2 best practices and briefly describe 1 or 2 items. So that's a kind of probable question. Once we do this, so we basically discuss about culture. What is culture? What's organization culture, country's culture, and come to the banking credit culture, right? Then most importantly, we discuss about credit facilities. We try to classify the credit facilities mainly direct, indirect, and further subclassify about tenor to asset like that. So it's good that we know what is direct and indirect, what are the features of direct and indirect, some examples of direct and indirect. That could be your probable question. Right? So here, thereafter, we learn about some product types. So it's good that at least you learn 2 or 3 products to write a short note, maybe OD, or maybe like bank guarantee, right? Maybe some working capital, or maybe term loan. It's good that if you can write a short note on 1 or 2 products, because it's anyway important for us to do day-to-day banking. Right. So with that, I think we have completed the part 2 of the credit management area. Then today we started the part 3. Today, in the sense, last week we did the character as one of the 5C, and then here again we learned about 5 C's in detail. What is character? What is capacity? What is capital? What is collateral? What is condition? So important for again exam, and out of this, so we try to write a kind of a short note on each. So that's again important, right? So what is character, and what is the factual kind of thing? What is capacity, capital, collateral, right, and security? So we went discuss lot on collateral. Why the collateral are important? What are the features of the collateral? Why? What is like the importance of the the collateral when we are consideration of the collateral, right? Then conditions. Conditions 2 types. One which we have not put down here is about external condition. It's about the market, management, technical, political, legal, and here the conditions are purpose, rate and interest, and repayment terms. So then also we touch upon the 5 pillars of credit, which is a commercial lending. That is environment, industry and market, financial quality, management quality. Those are the four. And as a result of positive and negative, we do a structuring, mitigation, and a collateral part as the fifth pillar. Then we try to understand about the risk, which I am not going to test you on detail because this may not exactly relevant to the credit part, but it's important in terms of lending as the because we are in the business of lending, we are minimizing the risk, maximizing the profitability for the bank. Is the risk Y stand for to likelihood and impact is the two concepts. Other elements also we learn. Overall risk function, right? And credit worthiness versus the credit risk also we discussed, and how we are going to manage in the credit risk. But this could be only important slide out of the risk, right? Because credit risk management is important in these days because the things are beyond going beyond out of control. So in that context, this is important. So with that, we completed the part 3, and then part 4 is basically about recovery and follow-up. So there are 3 important areas. That is identification. What is problem loan? So problem loan is above normal risk due to these, and then we try to identify the problem loan by different methods. And why we need to identify? Because there are some common features for these problem loans. Like there are 10 points that we have discussed. Important to understand what are the symptoms, what are the danger signals, what are the common features of problem loan, and then we try to understand how we are going to handle once we identify the problem loan, what we can do as a banker. So we learn here, and then when we understand, identify the problem loan, we try to handle it through soft activities and hard activity. Soft activity is something visiting, meeting, and offering some solution, restructure, reschedulement. Hard activities could be like legal action sort of thing, right? Through recovery, through negotiation and other. And finally, we try to understand how we are going to avoid problem loans. Credit control, right? What are the things that you can do to manage the performing loan not going to the non-performing category? That's about the credit control. The last part is a checklist, which is important for whoever who is right now doing credit functions. So that's all about the 4 presentations, which runs across about these 3 days. I think we were able to make a kind of some impact by doing this, though it is online, but it is good if you can do it. Physical class is much interactive, but depending on these circumstances, this is the only possible way out, right? So that's all about from my end. But now it's up to you to have any questions, any areas of further clarification. Please, forum is open for you. So please have your concerns, feedback, any thoughts. Chatura, Achini, Ashani, any question? Kushan? No questions? All well? All good?
Before the session wind up, I also thank you, sir, very much. And you give the valuable thoughts regarding the credit section. And your experience also, it's vital for us. And thank you for joining with us, sir.
Thank you so much for the kind compliments on behalf of the team. So I must say that you're very active, very participating, and so it's like so I didn't feel this is like a online class, right? So it's more or less like active participation made me also interesting in sharing kind of thoughts. But going forward, if you do have any questions related to on the job, off the job, or maybe what we have done so far, you can call me. This is my number. right? Anytime you can call, and my landline is like anytime, call me and get things clarified, whatever relevant to subs, and even when maybe when we are nearing the course. Again, if you do have some kind of course interconnections from the other, so please call me without any hesitation. So based on my availability, we'll be able to answer you. Then I thank you, every of individual of you who participated before the class for the last 3 sessions under different and difficult circumstances, and also wish you very great year ahead, and always careful whenever and whatever you do, because things and the happening is not easy, right? And always you have to do work, especially who are working in the banks. I know for sure very difficult to move around, and the banking environment is also a bit of troublesome these days, but be careful every time. And again, thank you very much for joining me, and always you are welcome to question me and sharing thoughts, feedbacks, and any difficulties, any questions kind of thing when you come across in you further 4 to 5 months yet to come. And that's all from my end, and thank you again for everybody. Wish you safe and fabulous new year ahead. Thank you.